Professor Don Bush, and I'm glad you're here. I've been a professor for about 30 years and a CPA for about that long, and I've got great ways to explain accounting. So welcome, and here we go. We're studying cash flow statements, and this is at the intermediate level. This is the third example. And each example becomes a little bit more detailed, a little bit more complicated, but if you follow each example, they're not too bad. You got to take them in order. So here we go. What we have going here, folks, we've got Fred's snowblower service, and we have an income statement here. And as you know, the income statement is done on the accrual basis. We recognize revenue when revenue is earned, and we try to match revenues and expenses together. And that is how an income statement is done, and it's not done on a cash basis, but we're going to use the information off of this income statement to create a cash flow statement. So what we'll do is we'll start with net income. It looks like Fred's not doing so well. His net income down here is a negative $21,500, but let's see what the cash flow is saying. Now, several items on this income statement have nothing to do with cash, like depreciation expense for $8,000, amortization expense for $500. Also, the loss on sale of equipment has nothing to do with cash. Loss on asset impairment, same deal. And this gain on sale of equipment, that has nothing to do with cash either. And we also have this interest expense here. What's going on is that there is a bond discount that's being amortized, so we'll take care of that. Now, in order to do the operating section of the cash flow statement, we need to look at our income statement and our balance sheet. Now, not just one balance sheet, but what we need is last year's balance sheet and this year's balance sheet. So what we'll do, we'll look at last year's and then we'll look at this year's and see how much things have changed. And we'll take it one at a time. So we've got current assets, current liabilities, but one weird thing is we've got one non-current liability here called deferred tax liability. And it looks like the deferred tax liability was $2,000 and grew to $4,000, so it increased by $2,000. So we'll see how to handle that. It's really quite easy. This is about the only example of a non-current liability that I know of that goes in the operating section of the cash flow statement. So here we are. Let's go down to the cash flow statement. I'll show you what it looks like in total. What we're doing is focusing on operations. We are not working on the other sections of this cash flow statement. So here we are. Here's the cash flow statement, and it goes on and on and on, and it looks pretty complicated. Looks really difficult, but it's not that bad. We'll just take it one step at a time. So in order to do this, I'll split the screen here. The cash flow statement always begins with net income. So we write down net income, and in this case, it was not a net income, it was a net loss. Here we are. Net income negative $21,500. So $21,500 doesn't require any calculating or thinking. We just write it down. Now, the next thing that we do is we add back very typical non-cash expenses, like depreciation expense right off the income statement. There we go. Add back depreciation expense, $8,000. And then add back amortization expense of $500. And same thing with the losses and expenses. They're kind of like cousins, and so you add them back too. So loss and sale of equipment, add it back. And same thing with loss on asset impairment, we'll add it back. But the gain has nothing to do with cash. Here we are. Gain on sale of equipment, $5,000, has nothing to do with cash. So in order to make this net income more cash-like, we are going to deduct it out. So in a nutshell, add back non-cash expenses and losses and deduct out gains. That's all you got to remember. Now, coming down here, the next thing is going to be this bond discount. There it is, interest expense. Now, in order to figure this out, you can think this thing through. It is possible to do that. But you have to have a pretty good understanding of how bonds work, or you can just memorize it. And this is just how I remember it, is that bond discounts you add back. Bond discounts are, what's going on is amortizing a bond discount is making it so the interest expense is greater than the amount of cash that was actually paid for interest. So what you do is you add back amortization of bond discount, add it back. So coming down, so I think we've taken care of that income statement. It is done. So let's go up here to the balance sheet. Balance sheet, and as I said here, we've got two balance sheets. We got last year's balance sheet and we've got this year's balance sheet, and we are looking at the change. So accounts receivable. Accounts receivable was $5,000, now it's $6,500, and so the change is a upward change. Accounts receivable grew by $1,500. Now, when accounts receivable grows, that means that you're selling your stuff, you're selling your inventory, but you're not getting paid. So Fred is selling snowblowers and he's repairing snowblowers, but he is not getting paid. And when you don't get paid, that is not good for your cash flow. So coming down here to the cash flow statement, we write it like this: less increase in accounts receivable minus $1,500, because it reduces your cash flow. Inventory was $20,000, now it's $18,000, so the inventory is dropped by 2. Now when inventory goes down, hopefully that means you're selling your inventory, and if you're selling your inventory, you're probably getting cash. So selling that inventory, here's how we write it: add decrease in inventory, $2,000, and that's a positive $2,000. Coming down to short-term investments, it was $5,000, now it's $8,000, increase of $3,000. Now, in order to increase your short-term investments, you have to buy short-term investments, and whenever you buy something, that decreases your cash. So less increase in short-term investment, negative $3,000. And I hope you're seeing the pattern here, that when current assets go up, your cash goes down. And the opposite is true too. When your current assets go down, your cash goes up. So let's see if that works for prepaid expenses. It should. So prepaid expenses were $2,000, they dropped down to $1,500, so there was a decrease by $500. So whenever current assets go down, cash goes up. So add decrease in prepaid expenses, $500. So coming down to the next area here, current liabilities. We look at current assets and current liabilities on the balance sheet. So here we are, accounts payable was $5,000, now it's $4,000. Looks like accounts payable dropped by $1,000. Well, how do you make your bills go down? You have to pay them. And when you pay your bills, your cash goes down. So here we go, less decrease in accounts payable, $1,000. Accrued expenses payable, that's like interest, wages that have accrued but haven't been paid, was $600, now it's $700. Your liability here is growing, and when your liabilities grow, you're in essence borrowing money. Add increase in accrued expense payable, so it'll be a positive $100. Now, current liabilities, the way they work is when the change is up. When the change is up, cash goes up, and when the change is down, cash goes down. So it's pretty easy to remember. Add increase in taxes payable. So let's see what's going on with taxes payable. Taxes payable was $2,000. Now it's $3,000. It grew by $1,000. So the liability has grown, and in essence, we are borrowing money from the government here. And so whenever you borrow money, that's an increase. So add increase in taxes payable, $1,000 positive. Wages payable. Wages payable was $3,000. Now $5,000. It grew by $2,000. And so the liability grew, so we're essentially borrowing money from our workers. Add increase in wages payable, $2,000. And then here's an odd one. This is about the only example that I know of where it goes in the operating section, and it comes from the non-current liabilities. So this is kind of an oddball. Deferred tax liability, $2,000, was $2,000, now it's $4,000. It grew by $2,000. So this deferred tax liability grew by $2,000. And how do liabilities work? When liabilities go up, you're borrowing money. So add increase in deferred tax liability, $2,000. Now what we do here is we get a grand total. I'm going to take away the split. There we go. Get this cash flow statement where you can see it. So look at that, folks. We covered it. Didn't take us too long to do. After a while, you get really fast at it. And so if you total up all these numbers in this column, you get a positive 8,150. So what's going on here? Net income was negative, and you ought to expect a correlation between the two. If one is positive, you'd expect the other one to be positive too. What we're doing is we're measuring operations in two different ways. In the first way, net income, it's measured on the accrual basis, and we mentioned that revenue is recognized as it is earned. And down here, we're measuring operations on a cash basis. On a cash basis, it's a positive 8,150. So you want to look into it and find out, well, why is it positive? It's really great that it's positive, but why? And the reasons here are we have a lot of non-cash expenses. We also had losses on like the sale of building and loss on the asset impairment, and those are not good. So cash flow from operations here, even though it's positive, it's not really as good as you would think. So anyways, coming down here, we're not working on investing activities or financing activities, but just for the sake of completeness and for repetition, we'll go over it real fast here. So here's the second section of the cash flow statement, which we're not covering today. Cash provided used by investing activities. What that consists of is the sale or purchase of long-term assets, property, plant, and equipment. So when we say investing, we mean investing in the company, investing in ourselves. Cash provided used by financing activities. What's going on here? Well, this is borrowing or paying back long-term debt. And it also includes owner investments and owner withdrawals, any transaction that involves owners. So folks, that was a quick rundown of the operating section of a pretty complicated cash flow statement. And I hope this video helped you out. And if I went too fast, go back and watch it again and again and again, so that way you can understand it and get the hang of it. This is one of the more difficult ones here. So I hope you liked it. Hit that like button and the subscribe button, and let me know if you like these videos, and I'll make more for you. And until next time, over and